Joining us now for more to talk about interest rates and the fixed income market, Jeffrey Rosenberg, Senior Portfolio Director of Systematic Fixed Income and Managing Director at BlackRock. When did you finally, if ever, Jeff, get into the camp that maybe rates are somewhere near neutral, given maybe we need to go lower, obviously, I guess, but given a 3% GDP and an unemployment rate under 4%, when did that start to not just look crazy to you? Has it been months or quarters, or does it still look crazy to you?
Well, it's been years, Joe, and we're really talking about the shift since the post-crisis environment of structural changes to the economy that drive that outlook. Investors often look back in their portfolios. They look back to their personal experience, to 5% interest rates, the ability to get yield and income without taking a lot of risk. What the Draghi news is about today, what the Fed will be later this month, it's about the challenges of a slowing global economy and how central banks aggressively respond through very aggressive zero interest rate, negative interest rate policies. We've had a little bit of a reprieve from that in the U.S. We're going to start moving back in those directions. And it's just a reminder that it is a persistent lower interest rate environment, and getting back to those kinds of abilities to find yield without risk at those 5% levels, that's just structurally not going to happen again.
I don't remember maybe you didn't convince all of your overseers at BlackRock. I don't remember you years ago predicting 2%. I remember Larry talking about how rates needed to go up. So for years, you've known that we were headed back down to 2% and that was going to make sense, even though the Fed was in a tightening mode. You actually predicted all this?
No, Joe. So there's certainly periods where we talk about rising interest rates. For a long period of time, we talked about the need to normalize interest rates. It's about, what does that mean? What level does normal mean, right? That's the essence of your first question.
That's what I was asking you. When did it occur to you that, wow, we've been thinking about this wrong? Because you weren't predicting this. So was there a moment of awakening all of us at some point said, oh, my God, what's happening? It was inflation people talk about, or the globalization of interest rates, or weakness in Europe, or something brought us to the realization that maybe 3% isn't a given on the 10-year.
Yeah, I think it's over the course of the post-crisis environment. The initial environment, it's really about the shock of the recovery. It's about the appreciation of a recovery. When you think about 2009, 2010, it was really about dealing with the successive crises, from the U.S.-centric credit crises moving over into the Eurozone. And as we begin to emerge from that, then these longer-run structural issues start to become more dominant feature and less about the cyclical recovery. Remember, most of that was about the cyclical forces, but what we're talking about here are the structural forces. So in answering your question about when in the timing, it was as the cyclical aspects of the recovery started or became more complete, then there was a bigger focus on the structural element, and you had much more discussion about R-star and lower rates and the permanence of that because of these structural issues as opposed to the cyclical elements.
So the range over the next 5 years, the high and the low on let's say the average yield, either in the U.S. or sovereign yields or whatever, are we now in a 1 to 3 or 4% instead of a 4 to 8% world? Is it going to stay like this, Jeff? Is that what the structural changes are telling you?
Yeah, that's precisely what the structural impact is.
What are savers going to do? What are insurance
investors.
companies? Everybody's going to have to buy dividend stocks then or something.
Well, you have to do a couple of things. You've got to change your portfolio mix, or you've got to change your expected returns and your required returns, right? So when you think about that mixture, if returns are going to be lower, then savings rates have to be higher, or the amount of risk investors are willing to take in their portfolios has to go up. But certainly the level of expected returns from both stocks and bonds is going to a lower level. And that's a realization I think many investors have slightly come around to.
Frightening, though, Jeff. I mean, you think about Larry, Larry Fink's been very worried about people's and baby boomers' preparation for retirement. And it used to be if you had $1 million saved, you could have $80,000 a year maybe to live on. Now you got, what do you got, $20,000? I mean, what does this mean for all the people that were we're planning on, having a retirement and haven't saved enough money now. It's frightening, isn't it?
Well, it can be. It's about planning. And you got to remember there's two sides of that retirement equation, right? Part of the lower level of interest rates is a lower level of inflation. And so while there's a lot of debate about whether we measure inflation right, whether that inflation rate reflects my experience of inflation, that impact helps to mitigate a bit, but it doesn't mitigate the decline in real interest rates.
I mean, it's great if you're
exactly.
somebody young who's looking to buy a house for the first time and get a lower interest rate, but it's nowhere near what you would need if you've been doing everything you were supposed to do all the way through and retiring now. So
that for folks who have enough time in their retirement, you can start to impact that today. And that changes, number one, it changes your savings rate, right? If you can't get the increase on your savings through higher expected returns, then you got to change how much you're adding every year in terms of the savings rate. The other piece then is portfolio mix and portfolio strategies. Joe, you mentioned, does it mean more dividend stocks?
Yeah,
does it mean, more higher risk areas of the market? Does it mean using illiquidity in private markets and capturing an illiquidity premium? All of these things, investors across the spectrum, whether they're large institutions, pension funds, or individual retail investors, they're all have for a while now. It's not like this story is new, that we're in a lower return environment.
That's true.
So different types of investment strategies have certainly been employed.
A lot of
and
people
will continue to need to be employed.
Yeah, a lot of people were waiting, waiting for the higher rates to come, and now it's like, what happened? It's pretty staggering. I wonder if we get, when all of us are totally sold on this new environment, I wonder if that's the bottom in rates. Then they finally, maybe then inflation comes back and they go back up and no one locked in, everybody's got floating rate stuff and we float back up. I don't know. We're always going to get, whatever we get too sure about, usually the opposite finally happens, right?
Well, that would require a bigger structural change, and that isn't out of the question. And really, instead of talking about monetary policy, that's talking about significant structural changes around fiscal policy, which is possible, not likely in today's environment, but it is possible. You could have those changes, investments being made, structural changes to raise the potential growth level of the economy, which would raise these levels of expected returns. It's the lowering of the potential growth rate of the economy that really ultimately drives that base level of expected returns across portfolios.
Okay, Jeff, thank you.